kind of talking a little bit about loans and interest rates. And this was coverage from Paul Fiorillo. He's the head of research at Yardi Matrix, right?
Friend of the show.
This is a really great article too. And he shared some of his thoughts as well, some kind of extra meta thoughts on the on this council, the annual conference of the CRE Finance Council in New York. So Paul Fiorillo went there, said what's happening, and he's coming back with a great report.
Did we miss our invite on that?
Maybe. It was in New York.
Oh, yeah, man.
He said, and this really frames everything. In LinkedIn, he said, maybe the most surprising part was how little panic there was. A bank regulator told me he was surprised at how optimistic panelists were. I didn't see it as optimism as much as calmness that comes from the fact that the Commercial Real Estate Finance Council has been through several downturns and found ways to solve worse problems. The group will figure this out and get stronger in the process.
They just say all the money's made up anyway.
Yeah. It's a very nihilistic.
It's all made up. We're the ones that get to make it up. We're the bank.
What is money? Yeah.
I mean, I get that. That's a very not nuanced approach, but
fascinated by this calmness, especially considering, kind of the fervor and the anxiety elsewhere, and which is reflected in some of the other articles that came along.
Do you think, because I know on some owners panels, I think I talked about it once, that there was a little bit of like, I think everything's okay until like one person will be like, maybe it's not okay. And then all of a sudden, like the floodgates open a little bit, at least to some. But I have gotten the sense that people are playing their cards a little bit close to the vest, and no one wants to be like, our book is, because again, I assume a lot of those are publicly traded companies. No one's going to be like, oh yeah, our balance sheet, our book, garbage, dumpster fire. Like who's going to say that about their own business? Yeah.
And I did.
We're good. No, we're same here. We're very financially, we're very sound.
Yeah.
Sound.
I thought maybe related to the fact where like kind of if you move NOIs a few percentage points, somehow the valuations can be. There are some places where just a few percentage swings can lead to such a different swing in the success or failure of an investment, and it seems like they're in this moment where it's like holding a bat upright, where if you move a little bit, it can go like, but if you make these small, they're in this maybe small adjustment phase.
Well, it's all financial engineering, and we've talked about how like if you're on the margins and a little bit of financial engineering is going to kill your deal, like, maybe it'll help. There's some deals that are on the margins like that, but the deals that are going to have problems, they're so far away from those marginal fixes. Yeah. But like again, anything can happen with the stroke of the pen. I mean, we had a whole books of MBS securities that were bought up wholesale, no questions asked. The last recession. So like, again, the money printer exists, and it can, if the obviously you have inflation on the other side, but if the idea that if inflation is receding, or this could be done in an isolated. There are all kinds of tools that exist, and again, it is whatever the Crown says it is.
Awfully detached. Like I really did. I was telling you this before, and it's like the start of a Greek tragedy. It's like this expert hubris that's leaving them blind to the crisis until it's too late. There's this anxiety elsewhere, but they're like, really. I think. I mean, really, them being calm in this situation. The movie's already halfway written. Act 3 is coming up quick. I don't think there's going to be a twist at the end. I don't think there's going to be like, well, I guess you just named it. There could be a Deus Ex Machina. Someone could just write it away. So
you're making great points. We've seen this story before. I mean, just think back to the movie The Big Short, and near the end of the movie when I forget who was Steve Carell's was it Bond. Anyway, it doesn't matter. Was interviewing the guy from Lehman Brothers, and like as Lehman Brothers is crashing, the guy still is saying that no, everything's fine, and I'm buying more of it, and like the captain's going down with the ship, in all these cases. And again, not saying the ships are going down. I'm just saying that if they were, you wouldn't hear it from these folks.
Their job. That's what I was going to say too. Is like, is this like part of like the image of the banker? Like, are they? And I think part of it is that's
what
their job.
The SVB, the Silicon Valley Bank executive, said the week before.
Exactly. Yeah. Like everything's right. I picture them as all like these John Wayne, like, there's a storm coming, but we'll be ready.
I don't take any of these bankers as John Wayne.
Yeah,
I could be stereotyping incorrectly.
But I do agree. Yeah, they have an incentive to maintain this calm, and it's
anyway.
It's not like Mary Poppins.
No. But it could be there are all these tools available, but until the tools aren't available, they don't work.
Yeah. What I think was striking in this was there was one panelist that said how much private credit is going to come up. I don't know, use the word rescue or just finance. Yep. And he says that debt funds are raising a lot of money. They'll be the ones to step up and take the banks' 50% share. He said banks will be back, but I don't see that in the next year or two. This panelist is talking about 50%.
Yeah, it won't be us. It'll be somebody else.
Yeah.
It won't be us.
Yeah, exactly. That's to take a 50% share and then just have this calm demeanor. Doesn't make sense numerically. Now, I don't know how much of banks' total loans or their total business is built upon CRE, but this is the CRE Finance Council,
and that's the big. They're the big dog in the room. I mean, the banks. Yeah. That's where the debt funds and private credit. There's a ton out there.
Mm-hmm.
But if the biggest source of liquidity is in the market,
yeah.
Again, the argument that there's going to be vastly more liquidity than there has been, there's more capital available when the biggest provider of capital isn't going to be, is taking 50% reduction in the market.
Yeah. And they cite dry powder, and we've talked about dry powder the last 2 years. It's like dry powder some of this dry powder is waiting for like this ideal, perfect opportunity, and conditions are not ideal yet. This has got to take a little bit of someone like a brave investor that's willing to look for kind of diamonds in the rough or whatever, or has a tolerance for risk or lower returns that is associated with the kind of private credit and rescue capital, that kind of stuff.
I do think though on that subject, and I don't think this is not necessarily a good thing for markets, but I do think there's a lot of, we talked about it a little bit in the past, but there's some fatigue of being on the sidelines, and there's a rally in the stock market, again driven by big cap tech. FOMO is going to seep in.
Yeah.
And is that FOMO, is it going to be kind of I'm trying to think, the technical analysis term of whatever situation we're in right now. I don't think it's a dead cat bounce, but is it a I guess a bull trap? Is there a bull trap that exists, or whatever, something that exists that gives people some false set of confidence, and people start entering the market thinking that everything is great, but also just because they're like, I'm bored. I want to do something, or I need to do something because of this dry powder is going to evaporate.
It does seem like the attitude in the economy in general is like we're waiting for the opportunity to spend a little more. Consumer spending is doing okay.
Yeah, surprise. Yeah, people still want to be.
It's like people are leaving. They're like waiting to enter, it seems. But
and there's so many different cross currents that again, that's why there is so much disagreement or non-consensus, generally in the market, which is good. There's a lot of, I think, good things that are happening. I mean, we have like real risk-free rates, and I think we're getting into price discovery.
Mm-hmm.
But I mean, just throwing out another example, student loan furloughs or whatever. What's forbearance? Forbearance is supposed to be coming an end here in July. And that's a lot of renters. It's a lot of renters that all of a sudden they're going to have to basically adding another car payment on to a lot of folks.
Yeah. And not for nothing, even in that article that Paul Fiorillo, he noted some information from Green Street that finds office real estate values down 27% from March 2022 and apartments down 21%. I think that's worth a little bit of worry, or at least it kind of punctures the attitude of cool, calm, and collected that maybe permeated this meeting, and for good reason. It was a professional calmness.
Yeah, that's what I'm saying. You just have to have the peripheries on one end. This risk and dark clouds on the other end. You have potential upside, and the dry powder comes. The rescue capital comes to save the day, or things are okay. Things are all right. And man, we've talked about so many airplane analogies: soft landing, hard landing. maybe there is no landing. Maybe it's a mid-air refueling.
Yeah.
Like
we could hope for that.
and again, mere weeks at this point, the calls were for, it was like 100% chance of recession, which we said at the time, nothing's 100%. So like,
I still think about this a whole lot. They're calling for recession. They called for a recession.
But have we already had a recession? What is this?
Yeah, exactly.
What is this? We had 2 consecutive quarters of GDP declines, and they refused to call a recession.
Yeah.
Because there were mostly political reasons.
Yeah.
I mean, let's be real. It's optics. We don't want. What do you want to call this period? Just stagflation, just the mud.
Yeah, it would be. Yeah. It's definitely slower. I still don't think that people are in the same attitudes that we saw pervade during the Great Financial Crisis and like kind of the early teens, 2010s and stuff.
But we had a crisis. It was called the pandemic.
Yeah.
We had a recession then. So it's like, and again, that recession was kind of unrelated to, again, we did a hard stop. We put a wrench in the gear of the global economy, and then we tried to like jumpstart it.
Yeah.
And we're like, oh, we're surprised that the engine is like a little rocky and bumpy, and we shouldn't be surprised if it just like flutters out and we have to restart it again, or if it's like and it starts working. Both of those things are possible. It's how do you position yourself to protect yourself from downside, but not missing out on the upside. And multifamily is in a unique position because if you can find the opportunities that do throw off a decent amount of cash flow, the fundamentals of multifamily over the next decade are strong. The housing market, we are seeing the data of housing market resilience. There's so much demand. We've talked about there's so much demand. 2 things are happening. A couple things are happening now, but in the face of rising interest rates, also in the face of new supply.
Yeah.
In the multifamily and single family side, occupancies are now starting to come back, or vacancies are creeping up because they're seeing so much new supply. We're also normalizing from the pandemic. But like, what other cold water could you throw on the housing market that hasn't been thrown? And it's just like, just dodging bullets. And it's just, it's come down a little bit. But how many sectors, if you don't look at the entire economy, if you look at sector by sector, where we've already had recessions, we've had manufacturing recessions. Commercial real estate is down 15-20%. Well, that's beyond a 10% correction. The different segment all tech has gone through a massive recession. So how many recessions do we need in different segments? And surprise, surprise, it's not falling into our typical textbook definition of recession, which we also changed.
Yeah, I think that, and I think what you noted there is really important. It kind of jibes with what I think is one of the biggest storm clouds that's looming over the economy. So I'm looking like, where is it? Where is this failure going to come from? A lot of people say the office market.
Yeah.
And this is what I was thinking of this past week is how does this looming implosion of the office market, which, it's still in process. It's but it's, because of 5-year leases, we may not see the full effects of this for, a year or 2 to come.